Mr. Stevenson, we know it's Mike, provides audit, tax, consulting, and other accounting services with emphasis on manufacturing, retailing, and wholesale and transportation industries. He also serves the tax and financial planning needs of individual clients. Other areas of special interest include preparation of financial statements, tax returns for consolidated groups, nonprofit organizations, partnerships, common interests, realty associations. He earned his undergraduate degree from Columbia College in 1980, his master's in business administration from the University of Puget Sound in 1981, and a master's of science in taxation from Golden Gate University in 2008. He joined Brink & Sadler in 1982, became a stockholder in the firm in 1996, and serves as a vice president and secretary. Prior to joining the firm, he served 11 years with the United States Army, retiring in 1995 from the Army Reserve with 24 years of service. Mr. Stevenson is a member of the Washington Society of CPAs and the American Institute of CPAs. He is a past president and past director of and club chairman for the Rotary Foundation Committee for the Rotary Club of Tacoma South, and past president of the Mount Rainier chapter of the Institute of Management Accountants. He is a certified management accountant and a chartered global management accountant. He is a past chairman of the board and a past president of the Lakewood Chamber of Commerce and past president of the Puget Sound chapter of the WAA. He is a past director and president of the board of directors for Clover Park Technical College Foundation and the past vice president and secretary of Lakewood United. He is a member of the Tacoma Business Connection, a business referral. Mr. Stevenson holds a license to practice in the state of Washington, issued by the Washington State Board of Accountants. His community activities include involvement with the Olympia chapter of Trout Unlimited, the Lakewood and Tacoma Pierce County Chamber of Commerce, the Courage Classic sponsored by the Rotary Clubs of Pierce County for Marybridge Children's Hospital and Tacoma South Rotary, fishing rodeo in conjunction with the Boys and Girls Club in Pierce County, and repack projects with the Emergency Food Network. I'd like to welcome Mike Stevenson.
No wonder I'm so tired. Yeah, well, thank you. I know that was quite a lot to go through. John Graycheck asked me to talk about how you calculate taxes. And then he didn't come to the meeting.
Yeah, tax it with easy. Well, have him come in for an hour and charge him for it.
That's what I'm gonna do. That sounds perfect. So we're just gonna, it's pretty easy what we're gonna go through. I gave you 8 different tax returns just to give you an idea what happens when you're trying to do it. Now there are tax rates, which look like this, and that just tells you whether you're single or married and what the different breakdowns are, which is what I think he was interested in. And then there's tax tables. So if you're under $100,000 of taxable income, you use the tax tables instead of the tax rates, which either gives you a $2.50 or $3 bonus or a $3 more than you would have had to pay. And I'll show you that in the very first one. This young John Doe, of course, not the real John, 19,000 of income, $350 of tax. So he has a total of 19,350. He just has standard deductions, standard exemption, so he ends up with $9,000 of income. And if you were to look at the tax rates, he would be taxed at 10%, which would be $900. But if you go to the tax table, it goes from $9,000 to $9,050, and the tax is $903 for a single person. So he actually ends up paying that little bit of extra. Tax tables are here. You all have those. You can see where they go across. And this is a single individual. I figured that would be much easier to follow. So then you go to the next tax return. Same guy, Only difference is now he got lucky on his stock and he sold it for $31,000 and he ended up with a $28,650 capital gain. So he has the same amount of income as he had before, same deductions as he had before. And lo and behold, this is one of the few benefits the IRS has. His tax is exactly the same as before he had the capital gains. And that's because when you're in the 10% bracket, your capital gain rate is 0 until you get over the limitation, which I believe is 30,000.
Is that including all kinds of capital gains or just specific types of capital gains?
You could have, that's most long-term capital gains. You could get stuck with some recapture, and if you had that, then it would probably end up in a little bit higher.
So Mike, this capital gains, it's kind of a general term. Does that include like a bonus from work? You start.
Any earned income is not, capital gain is from the purchase or sale, or the sale of an asset, either personal or business asset. Stocks, bond, everything. Anything that you sell, it was yours. But no, anything that any services you obtain is going to be ordinary income.
Does that mean selling a car too?
Yes. Technically, if you ever bought a car and sold it for more, your personal car, and you sold it for more than what you paid for it, you're supposed to pay capital gains on your tax return for that amount.
That's not gonna apply if you're just selling your Camry or whatever. That will depreciate it.
Yeah.
If you like,
It's,
do up a vintage car and sell it for more than what you bought it for. If you pay
well, it would apply to her car if she just happened to be a real savvy buyer and went out and bought Mandan's Cadillac for $3,000 and sold it to John for $5,000 the next day. But
I guess that could.
And on your recapture then, if you sell your investment property, the capital gains would not be taxed, but the recapture would be.
no, it's a long form that you have to go through all of it. It's all considered capital gains, but just some of it is taxed at a different rate.
Okay, so
And you'll see that. Now, if you go to the same one we're just on, if you go to about the 5th page, looks like this. Okay, and that's the worksheet that tells you how to calculate your tax. And Rick, you can see on there,
No, I can't. I need my glasses.
you need your glasses. But anyway, as you go down this list, it takes into consideration all of those things.
I always forget, so you're saying that the 15% starts at 30,000, something like that? Let's just call it 30,000. So if you make 20 and you have a capital gain that's 15, that means that puts you in the 15% bracket according to how capital gains are calculated. So then is it only the 5,000 that's capital gain taxed? Or is your entire capital gain taxed?
Your entire capital gains tax. And you'll see that here. Well, on this one, you don't see it very well because it's 0, but you can see the person at $37,650. You subtract the capital gains, and then you have the ordinary, which is $9,000. That's what he actually got taxed on, was at $9,000. You go all the way down the chart, and it shows that he was under the limit for the next level, so he ended up with 0 tax on the capital gains. And if you look at line 26, that's what tax he would have had, and all of his income would have been taxed at ordinary rates.
Now, is that short-term versus long-term too? Makes no difference?
It does make a difference. This is long-term. Short-term just offsets ordinary income, basically. Because it has to get to the long-term phase. Okay. Let's go to page, or the 3rd one. So now the guy's gonna make some more. We're gonna give him $60,000 more.
Moving up.
So he gets he makes $79,000 in wages, $350 in interest, $28,650 in capital gains. Now he makes $108,000. more realistic for most people.
And he still doesn't know how to do his taxes, does he?
And he doesn't have any itemized deductions. So now he ends up, with basically, what is it, $17,326 in tax on that one. And if you go to back to the worksheet again, you'll see that all you have to do is go to that worksheet, you got 97,650 in taxable income. You subtract the 28,650, you get 69,000 of ordinary income. This page again. Rick, this page again.
I'm trying to find what page, how far.
Just flip, they're all in a row, so it's about the fourth, depending on which one we're on.
No, got it.
Okay, so it goes down and then you take the 69,000, go to the next page behind that, there's a table. So you find 69,000 in there, go to single, and you come up with $13,028. And if you look at line 24 of the worksheet, it'll tell you the same thing. It shows you that that's the ordinary tax on that line. Then it goes through and determines what level you're going to get taxed on the capital gains. In this case, the whole capital gains is going to get taxed at a 15% rate. Because now he's out of that 10% bracket, he's up in the 15% or higher. And so now he just takes 15% times the 28, which is 4,298. Then he adds those two numbers together and comes up with the 17,326. Line 26 again is what it would have been if they had taken the 96,650 and went to the ordinary tables. So he actually saved about $3,000 because it was capital gains instead of ordinary income.
Mike?
About 15%.
Do you have to do estimated taxes on capital gains during the year?
You should, yes. The idea of estimating taxes is to replace what everybody pays on the W-2 as withholding. And the IRS wants you to pay all your payments equally over 4 payments over each quarter during the year. So if you have a capital gain in the third or second quarter, let's say, then you should increase that. If you don't, as long as you're 110% of the prior year's tax that you owe, that you already paid in, and that's why most of us use that number, you won't get a penalty, but you'll still owe tax at the end based on the increase in income.
So if somebody who is a W-2 earner, wage earner, sells an investment property during the year, and then they don't make an estimated payment, they could get fined by the end of the year.
Right. Now, if they wait until December to sell it, you do have an advantage, because then and it's a big sale, let's say, you got hit with a penalty because you didn't pay in enough withholding to cover your exception. Then what you can do is annualize your income, and you annualize your income based on each quarter, so your wages and stuff will all be equal. It'll just be equal for each one of the quarters you're analyzing. But the time when you sold the property is, if it's the last quarter, would all be put in that last quarter. And so that would reduce the amount of penalty considerably.
And how long can you annualize it for?
Well, it's annualized over 1 year.
Just over 1 year?
Yes, 1 year.
Okay.
So if you're making salary reduction throughout the year from your pay deductions, and you sell right at the end of the year, you won't have expected to have made payments throughout the year. You can just go, okay, and I'm just going to pay right now for that part.
Right.
You're fine, right?
Right. Okay, number 4, on to the fourth one. So now the guy's doing a little better. Now he's up to 119,000 a year. Still 350 in interest, 500 or 58,650 in capital gains. So he makes 178, just like all of you, or a little bit less than most of you. And But he still is using itemized deductions, so yes, he's not planning properly. He hasn't bought that nice house unless it was already paid for. Okay, then, he really gets hit with tax then, so now he's up to $32,128. And again, if you go back to the capital gains, capital gains worksheet, you see at the very top, his actual taxable gain is $167,650. If you take out the $58,650, he now has $109,000 of ordinary gain. So now, you can't use the tables anymore, because the table only goes up to 100,000. That's what these tax rates are for. You should have one thing in the back here, and then you just find the amount on here, and you take, and this I think is what Tom was trying to figure out, because it doesn't actually come out the way you want. Go down to the second one, which is 2016. You would take his 109,000, subtract 91,150 from it, and you'd end up with 17,850. And then you look over to the left, and see that he'd have to pay 18,481. Oops, wrong one. 18,558.75, and 28% of everything over 91,000. So you multiply the 17,000 by 28, and you get 4,998. Add the two together, and you owe 23,577. And if you look at line 24, there it is. It already calculated it in the return for you. But if you were using the tax rates, that's where you get the number from. And it would kick it in here. Again, it comes down, takes the 58,000, he's still in the 15% bracket, even though he's up to 28%, he still qualifies for 15% long-term gain. So it's just 15% times the 58, which is 8,798. So you add those two together, and you get 32,355 if he was to have paid ordinary tax on the whole thing, he would have had to pay 39,979. Now it's going to get complicated.
Is this a real situation?
I know.
It's lost in the, so,
I didn't make it, I could have put in self-employment tax, and then it would have been way worse.
Yes. Way worse.
Or some actual sales where you had recapture. All you want to know is how the tax rates work and how you can calculate them.
Now, when you do these, Mike, are you using a computer program, or are you sitting there with your calculator?
These are all going through a computer program.
Computer program, kind of like TurboTax or Abacus.
CCH.
this reference electronic.
It's one of the, it's ProFX systems. Anyway, so the next one, he's still got the same amount of salary, same amount of interest, same amount of
We're at number 5.
yes, same amount of capital gains. But now all of a sudden we're going to give him $40,000 worth of itemized deductions.
Yeah, like that.
And so this was just to give you an idea. If you had itemized deductions, make a big difference as to what kind. If you go to this next page behind this, where it shows that he owes $23,000 now instead of 32, he only owes 23 now that he has 40,000 in deductions. The extra 1,366 is your sales tax deduction by chart. That's why it's a little bit more. If you look at that, I said that it was all interest that he paid. So interest on his home. So he got the benefit of the interest, and he ended up saving 10 grand in taxes. The procedure for the worksheet was exactly the same. The number was just lower to start with. And so it still comes out the same, and instead of saving 10,000, he saved 7,000 because now he's paying at a lower rate. Okay, now you go on to That was 5, right? Now we wanted 6.
Is the sales tax always something that you include in people's returns? Do you make an assumption, or?
If you do not put in specific sales tax for the entire year, or sales tax on specific items, then it goes automatically to a table and looks at it. And anybody that makes a lot of money should actually try to keep track of their sales tax, because they usually spend a lot more than most people, and use that. I've had doctors that have had 15 or 20,000 in sales tax deductions over a year, and the chart would have only given them maybe 2 or 3 grand.
And you will get audited if you don't have that in there. We have a mutual friend who got in trouble for that.
I've gone through a couple of them, never had a problem.
Yeah.
But anyway, so this one, now we're just gonna change number 6 from 5 by, instead of saying, Rick's not gonna like this one, instead of saying that it was interest expense for the $40,000 deduction, now it's gonna be real estate taxes for the 40-some thousand. Now, if you go back and look at his income, what happened?
Where are we at now? Number 6.
6. Second page is 6, go to.
Page 2 is 6.
Yeah, so notice the guy had the same amount of income as before, same amount of itemized deductions. Now he owes $30,000 instead of $23,000. And that's because he got hit with the lovely alternative minimum tax. And that's because real estate taxes are one of the items that is subject to alternative minimum tax, and it actually adds it back to your income for determining alternative minimum tax, which means they're going to recalculate your tax based on a flat rate of, I'm going to say 28%.
And he could have avoided that if he'd have done a 1031 exchange.
Well, this could be just property the guy owns. He inherited it, who knows what he did. If he owns the property, he's gonna have the real estate tax if he's paying it. So he's kind of stuck there, but he has the other ways he can get other reductions in order to get out of the alternative minimum tax. Or make more money and get out of it by paying more tax. We'll know if that's a good idea. So that was the main difference here, is that you have the alternative minimum tax. How much time do I have?
Is there an income value when the AMT kicks in?
It depends on, yeah, there is. If you're under a certain amount, like I think it's 70,000, you can look at the alternative minimum table.
So isn't that the main argument with the alternative minimum tax? Not that it's such a bad thing, but that it never was adjusted for inflation from when it started. So middle-class people are being affected by the alternative minimum tax now than it used to be.
Yeah, single or head household, 119,000. Married, 159,000. And then it varies what your exemption is after that. So it adjusts the amount that you have for that. And again, the capital gains is done exactly the same way. The alternative tax is an extra tax after the fact when you've done this. It's on a totally different schedule. So you have your capital gain one, and then it goes over to the alternative minimum tax schedule, which does this minimum calculation basically. This makes sure that the rich guy doesn't get away without paying his share of tax. That's what theory was. But it doesn't work very well. And they found that more middle class get hit with it than rich people get hit with it. Because if you're rich enough, you're gonna pay enough tax that you'll never get in that rate anyway.
I read that tax return that was Donald Trump's tax return that was leaked from 2005. He paid $38 million in taxes, and like 37 of it was the alternative minimum tax.
And that's quite possible.
How do you get away, or how do you keep from being surprised with that at the end of the year? Is there a way to tell that you're going to get hit with it?
Yeah,
See Mike several
I am a
times a
good
year.
professional. And not just hire a good professional, you come in and see them in September and go through your stuff and say, hey, this is what I think is gonna happen. Now because you don't wanna wait until December, it's too late for most things to be able to do anything about it. But sometimes there's not a whole lot you can do about it. If you make money, you can end up doing it. Okay, 7, now we're gonna kick it up a little. So on 7, guy makes $119,350 in interest, $100,000 in dividends. This is one of John's clients now. $58,000 in capital gains again. So now he's up over the $278,000 limit. He still has the $41,000 or $40,000 of interest expense, so he's going to get a deduction for that. And his tax is $50,740 for this regular tax. Well, actually, that's all of his tax, except for if you go down to line 62 on his return, all of a sudden you see a new tax. And this is the net investment tax. This is what happens when you get over, I believe it's 200,000, and then you get, or over 250,000 adjusted gross. For a single person, it's more for married. And if you look, page 1. The capital gain is still done the same way. None of that changes. You still have the ordinary rate, then you have the capital gains rate, then you go from there. Then, if you go to the next page, it says net investment income tax, and that is Form 8960. And so you go through it, takes all the things that are investment income, the 350 of interest, 100 of dividends, the 58,560 or 650 of capital gains are all counted. Then it takes that, compares it to your adjusted gross, takes out the 200, has 78,000 left. And from the 78,000, it goes ahead and applies its 3.8% bracket and charges you an additional $2,964. And then as a real quick ending, if you go to 8, same numbers, only now we go back and make the itemized deductions. Real estate taxes, and now he has 11,000 of alternate or alt-min tax, plus he still has the $2,964 of the additional tax, so now he's up to $67,000 in tax based on his additional income. And I'll give John his one question. But yeah, it's not up.
Now,
That doesn't add up. Look at this. 65,443 plus 2,964 is 68,300.
Oh, okay, move your finger to the left. And I didn't mention this before, because this guy didn't do what Rick was talking about earlier, making his estimated taxes. He is paying on all of these, he is paying his underpayment penalty, which means he did not pay in his withholding. So that number to the left that adjusts the bottom line is the additional penalty that he's paying for not paying his money in. So this guy paid what,
That's in that 2,964.
Right. It automatically adds it in there unless you pay for it. And if it's after April 15th, then there's going to be an additional tax and penalty on that. Not tax, penalty and interest.
is that, he has a other tax on line 62. Is that the Obamacare tax part of it?
Yes.
Okay.
That's the additional Medicare, is where it goes.
It goes to Medicare? It doesn't go to a special fund that Obamacare was?
I believe it's for Medicare, but I'm not 100% sure.
Medicaid.
Medicare. Medicaid is tax, or
Yeah, no,
isn't it state, more state?
I'm not sure on that where it goes.
That's what
We always say Medicare, but it could be Medicaid also.
Yeah, Medicaid
It's
is.
wherever the government wants their drugs, probably. Okay?
One more.
Planned
I
Parenthood.
have agonized over this for years. What constitutes, or what kind of things would constitute tax exempt interest?
Municipal
No,
bonds.
You need
There you go.
bonds.
Municipal bonds are one example.
Oh, okay.
Government bonds, city bonds.
So, you know, wealthy people that want to bring their tax rate down will buy a municipal bond. You get a lower yield on it typically than you do on an investment grade corporate bond, but you also don't have to pay any tax on it.
And is that the incentive then to invest in municipal as, okay.
Private activity bonds are usually that way. Is that it?
That's it,
All
yeah.
right, thank you.
Thank you.